There is a lie that sits at the very heart of modern finance. It's a seductive, glittering trap that has ensnared generations of investors, from the novice retail investor just starting their journey toward financial freedom to seasoned asset management professionals controlling billions. The lie is that growth is the goal. We are told to hunt for it, to celebrate it, to pay any price for it. We see a company whose revenues are doubling year over year, and we are conditioned to feel a jolt of excitement, a fear of missing out. The media screams the growth story from the headlines, analysts build complex models projecting that growth into infinity, and the stock price soars on the intoxicating fuel of pure narrative. But what if this frantic chase, this obsession with getting bigger, is a costly distraction? What if it's a market trap designed to separate you from your capital? What if the real secret to wealth creation, the kind of automatic, compounding wealth that defines the careers of legends like Warren Buffett, has almost nothing to do with growth for growth's sake? The truth is, a business can grow itself straight into bankruptcy. It can add billions in revenue while simultaneously incinerating billions in shareholder capital. It can become a giant, sprawling empire that is fundamentally less valuable to its owners than when it was a small, focused operation. The market is littered with the corpses of these so-called growth stories. Companies that hired thousands of employees, opened offices around the world, and captured immense market share, yet consistently failed to do the one thing a business is supposed to do: generate a satisfactory profit on the capital entrusted to it. This is the costly mistake that defines the path of the 99% of investors. They buy the story, they chase the revenue, and they ignore the engine room of the business. They mistake activity for progress and size for value. The financial transformation you are about to undergo is the adoption of a single, powerful lens that cuts through the noise and reveals the true quality of a business. It's a financial metric so profound, yet so often overlooked, that Warren Buffett has called it one of the most important factors in his analysis. It's not a secret, it's not hidden away in some complex formula, but understanding its deep implications is the key that unlocks the door to a different kind of investing. This is the principle of return on equity, or ROE. And it is the primary filter that will allow you to stop chasing stocks that just get bigger and start investing in the hyper-efficient businesses that are true compounding machines for shareholder capital. You will learn to see that a small company earning a 30% return on its capital is infinitely superior to a corporate giant earning just 5%. You will learn how this single number is the truest measure of a company's ability to create wealth for you, its owner, almost automatically. This is not just another piece of financial education. It is a fundamental shift in your investment strategy, a recalibration of your entire approach to the market. You will move from being a speculator on stories to being an owner of extraordinary businesses. Our journey begins not in the chaos of a stock exchange, but in a quiet, unassuming candy shop. This is the first pillar of our understanding, the ROE compass, discovering the true north of profitability. It's about learning to see what Buffett sees, to use this single metric as an unwavering guide to identify businesses of immense quality, often hiding in plain sight. In 1972, Warren Buffett and Charlie Munger were presented with an opportunity that would forever change the trajectory of Berkshire Hathaway and crystallize their investment philosophy. It wasn't a technology company, it wasn't a revolutionary new industry. It was a family-owned chocolatier based in California called See's Candies. The company was being offered for sale by the See family for $30 million. At first glance, Buffett almost dismissed it. Berkshire's book value at the time was only around $400 million, and paying $30 million for a candy company seemed steep. The business had tangible assets, things like factories, stores, and inventory, worth only about $8 million. The seller was asking for a price that was nearly 4 times the company's net worth on the books. This is where the average analyst, the average investor, would have walked away. They would have looked at the balance sheet and concluded the price was outrageous. They were asking for $22 million of goodwill, a phantom asset that represented the brand, the customer loyalty, the reputation, things you couldn't touch or easily quantify. But Buffett and Munger had begun to evolve their thinking beyond the strict cigar-butt investing of their mentor, Ben Graham. They were starting to hunt for wonderful businesses at fair prices, not just fair businesses at wonderful prices. And See's Candies was, by their emerging definition, a truly wonderful business. How did they know? They looked past the simple book value and focused on the engine of profitability, its return on equity. See's was earning about $2 million in after-tax profit per year. Now, if you relate that $2 million in profit to the $8 million in tangible assets, you get a staggering figure. The business was generating a 25% return on the real capital tied up in the business, a 25% ROE. Let that sink in. For every dollar the See family had invested in the physical operations of the business was spitting out 25 cents in pure profit year after year. This wasn't a fluke. It was a consistent, durable feature of the business, powered by a beloved brand in a stable market. Customers in California didn't just buy See's chocolates. They had a deep emotional connection to them. They bought them for holidays, for birthdays, for apologies. This brand loyalty gave See's pricing power. They could raise prices a little bit each year to cover inflation, and then some, and their customers would happily pay it. This meant the business required very little new capital to grow. It didn't need to build massive new research labs or multi-billion-dollar factories. It was, in Buffett's words, an economic franchise. Buffett's partner Charlie Munger pushed him hard. He convinced Buffett that paying a premium for this kind of quality was not a mistake. It was the entire point. After some negotiation, they agreed to a price of $25 million. It was the largest purchase Berkshire had ever made, and it was a pivotal moment. Over the next few decades, See's Candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring only about $40 million in total additional capital investment. That initial $25 million check had unlocked a gusher of cash, a river of profit that flowed back to Omaha to be redeployed into other wonderful businesses. The real genius of the purchase wasn't just the $2 billion in profit, it was the fact that the business generated all this cash without needing to retain it. The high return on equity meant that profits could be pulled out of See's and invested elsewhere, while the core candy business kept humming along, minting money on its tiny capital base. It taught Buffett a lesson he would repeat for the rest of his life. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And the primary indicator of that wonderfulness was its consistently high return on equity. This single transaction, this purchase of a simple chocolate company, became the foundational anecdote for their entire quality investing framework. It was the compass that would guide all their future capital management and asset allocation decisions, pointing them relentlessly toward businesses that gushed cash, not businesses that merely consumed it. The reason this ROE compass works so effectively, and why so many others ignore it, lies deep within our own psychology. The underlying principle at play is something behavioral scientists call salience bias. Our brains are hardwired to pay attention to things that are vivid, recent, and emotionally resonant. A headline screaming about a company's record-breaking revenue growth is salient. A charismatic CEO on a magazine cover talking about changing the world is salient. A stock price that has doubled in the last 6 months is extremely salient. These things grab our attention. They feel important. They trigger our fear of missing out and our desire for quick, easy wins. In contrast, a financial metric like return on equity is, well, it's boring. It's a percentage derived from a company's financial statements. It has no narrative, no emotional hook. It's a quiet, stable number buried in an annual report. It lacks salience. Because of this, the vast majority of market participants, the 99%, allow their attention to be hijacked by the loudest and most exciting signals. Their investment strategy is dictated by what the market is currently screaming about. They are drawn to the flame of the growth story, mesmerized by the narrative, without ever stopping to ask the crucial question, is this growth actually creating any value for me, the owner? A company can grow its revenues by 100% by simply selling its $1 products for 50 cents. The revenue chart would look like a rocket ship, the headlines would be ecstatic, but the business would be destroying capital with every single sale. Yet because revenue growth is so salient, investors flock to it. ROE, on the other hand, forces a different kind of thinking. It's a second-level thought. It asks not how big is it getting, but how profitable is it on the capital it employs. It is a measure of efficiency and quality, not just size and activity. By consciously choosing to make ROE your primary filter, your compass, you are deliberately overriding this powerful cognitive bias. You are training your brain to ignore the siren song of market noise and focus on the fundamental economics of the business. You are choosing the boring but true signal over the exciting but often false one. This is a core part of the CEO mindset that distinguishes great capital allocators. They are not swayed by what is popular or what is making headlines. Their decision-making is grounded in the cold, hard mathematics of profitability. They know that a business that can consistently generate a high return on the money it invests is a business that will build wealth over time. It's a simple, inexorable law of financial gravity. Buffett's genius wasn't just in understanding this intellectually, it was in having the discipline to apply it relentlessly, ignoring the clamor of the crowd and following his ROE compass toward true economic north, time and time again. So, how do we translate this from a story about a candy company into a practical tool for the modern retail investor? We need an applied mental model, a blueprint you can use to start your own stock analysis. Let's call it the quality first filter. This is a step-by-step process to make ROE the gatekeeper of your portfolio. Step 1 is simply to find the number. For any public company you are considering, you can find the return on equity on any major financial website, like Yahoo Finance, Morningstar, or in the company's own annual report. It's usually listed under the Statistics or Key Metrics tab, but don't just look at the current number, you need context. Step 2 is to look at the history. You want to see a track record of consistently high ROE over at least the last 5 and preferably 10 years. A company that has a high ROE for 1 year due to a one-time asset sale or some accounting gimmick is not what we're looking for. We are searching for businesses with a durable competitive advantage, and that durability will show up as a consistently high ROE through different economic cycles. Step 3 is to establish your own minimum threshold. What constitutes high ROE? Buffett has often looked for businesses that can sustain an ROE of 15% or more over the long term. Why 15%? Because over the long run, the return you can expect to make from an investment is closely linked to the ROE of the underlying business, assuming you don't overpay for it. If a business earns 15% on its equity year after year and retains those earnings to grow, its intrinsic value will compound at a rate somewhere close to 15%. The long-term return of the S&P 500 is historically around 8 to 10%. By setting your minimum hurdle at 15%, you are immediately filtering out the vast majority of average and mediocre businesses and focusing your precious time and capital only on the truly elite performers. This is a critical step in effective asset allocation. Step 4 is to understand the driver of the ROE. A high ROE can be generated in a few ways, and not all are created equal. The classic DuPont analysis breaks ROE down into 3 components: net profit margin, how much profit it makes per dollar of sales; asset turnover, how efficiently it uses its assets to generate sales; and financial leverage, how much debt it uses. You want to find companies with high ROE driven by high profit margins and/or high asset turnover. Be very wary of companies whose high ROE is primarily the result of taking on a massive amount of debt. A highly leveraged company can have a fantastic ROE in good times, but it can be wiped out in a downturn. Look for businesses like See's Candies, whose ROE comes from the inherent profitability of its operations, not from financial engineering. This blueprint, finding the number, checking its history, setting a threshold, and understanding its components, is your quality first filter. Any potential investment must pass this test before you spend another minute analyzing it. It is the first and most important step in building a portfolio of profitable companies designed for long-term wealth creation. To truly appreciate the power of this approach, we must dedicate a moment to its antithesis, the path of the 99%. What do most investors do? They operate without a compass. Their process, if you can call it that, is reactive and chaotic. It starts with a tip from a friend, a headline on a news channel, or a post on a social media forum. They hear about a hot stock in a revolutionary industry and are immediately gripped by the fear of missing out. Their entire analysis consists of looking at the recent stock price chart. If it's going up, that's all the confirmation they need. They don't open the financial statements. They don't know what return on equity is, let alone what the company's number is. They are buying a ticker symbol, a story, a dream, not a piece of a business. This investor might use some superficial financial metrics, but they use them in isolation, which is incredibly dangerous. They might say, "This stock has a low PE ratio, it must be cheap," without understanding that a low PE can be a sign of a terrible business with declining earnings and a low ROE. Or they might say, "This stock has a high PE ratio, it must be a great growth company," without realizing that its price implies a level of future profitability that the company's mediocre ROE makes almost impossible to achieve. They are grabbing random pieces of data without a framework, without a philosophy. Their portfolio becomes a random collection of popular names and speculative bets. They are perpetually chasing last year's winners, buying high and selling low in a panic. Their wealth management strategy is based on hope, not on the proven economics of business ownership. This path inevitably leads to frustration, anxiety, and subpar returns. It's the difference between being a ship captain with a compass and a nautical chart and being a castaway on a raft, tossed about by the whims of the ocean. The ROE compass provides the direction that the 99% so desperately lack. The direct financial connection here is profound and quantifiable. Let's make this tangible. Imagine two companies, Company A and Company B. Both start with a book value, or shareholder equity, of $100 million. They are in stable, mature industries. Company A is a wonderful business. Thanks to its strong brand and efficient operations, it consistently generates a 20% return on equity. Company B is a mediocre business, struggling with competition and inefficient capital management. It only generates an 8% return on equity, roughly the market average. Now let's assume both companies retain all of their profits to reinvest in the business. They don't pay any dividends. After year one, Company A earns 20% on its $100 million equity base, which is $20 million in profit. Its new equity is now $120 million. Company B earns 8% on its $100 million, which is $8 million. Its new equity is $108 million. Now watch what happens. In year two, Company A earns 20% on its new larger base of $120 million, generating $24 million in profit. Company B earns 8% on its $108 million, generating just $8.64 million. The gap in their earning power is already widening. Let's fast forward 10 years. Through the power of compounding, Company A's shareholder equity will have grown to over $619 million. Company B's equity will have only grown to about $216 million. The wonderful business is now nearly 3 times larger and more valuable than the mediocre one, despite starting at the exact same size. Its intrinsic value has compounded at 20% per year, while the other has languished at 8%. This is the automatic wealth creation engine in action. As a shareholder, your portion of the business has been growing at that underlying rate. This is how ROE directly manifests on the balance sheet and translates into a massive financial advantage for the investor who knows how to spot it. It is the mathematical heart of quality investing. The intoxicating narrative of growth is perhaps the most dangerous trap in the entire market. It's the second pillar of our system, understanding the fallacy of growth and why bigger isn't always better. Chasing revenue growth while ignoring the underlying profitability is the single most common and costly mistake an investor can make. It's a path littered with good intentions and terrible outcomes. To understand this, we need to travel back to the very beginning of Warren Buffett's own story, to the business that gave Berkshire Hathaway its name. In the 1960s, Buffett took control of a struggling New England textile manufacturer called Berkshire Hathaway. It was a classic cigar butt investment, a terrible business bought at a dirt cheap price. The textile industry in America was in terminal decline. It faced relentless foreign competition, high labor costs, and required constant, expensive upgrades to its machinery just to stay in the game. Buffett, the brilliant young manager, poured his energy into it. He worked to make it as efficient as possible. The company did grow. It sold more textiles, it employed hundreds of people, it was a big, active operation. But it was a horrifyingly bad business. For every dollar of profit the textile mills managed to squeeze out, they had to reinvest that dollar, plus more, back into new looms and equipment just to tread water. The return on equity was abysmal. The business was a capital sinkhole. It grew bigger, but it never grew richer for its owners. Every dollar reinvested into the textile business earned a pathetic return. Buffett himself later described this period as one of his greatest mistakes. He spent years trying to fix an unfixable business, pouring good money after bad, simply because he was already in it. He learned a critical lesson. No amount of managerial brilliance can turn a fundamentally bad business with low returns on capital into a good one. Now contrast this experience with the business he began to buy with the meager profits from the textile mill, insurance companies like National Indemnity. On the surface, an insurance company doesn't seem very exciting. But Buffett saw its hidden economic characteristic. An insurance company collects premiums from customers up front and only pays out claims later. In the meantime, it gets to hold and invest that money. This pool of money is called float. And for a well-run insurer, the float comes at no cost, or sometimes even a negative cost if they make an underwriting profit. Berkshire could take this massive, free pool of money and invest it in stocks and bonds. This was a business that generated capital, rather than consuming it. The return on the equity required to run the insurance business was extraordinarily high. It was the complete opposite of the textile mill. The textile business required enormous capital investment for pitiful returns. The insurance business required very little capital and generated enormous sums of investable funds. This contrast became the central pillar of Buffett's philosophy. He finally shut down the textile mills in 1985, calling it one of the best decisions he ever made. He had learned firsthand the critical difference between a business that grows by consuming capital and a business that grows by generating it. The growth in the textile business was value destructive. The growth in the insurance business was value creative on a massive scale. This foundational anecdote, the painful multi-decade struggle with the low ROE textile mill versus the explosive success of the high ROE insurance operations, is the perfect illustration of our second pillar. Growth itself is not good or bad. Growth is only valuable when it occurs within a business that earns a high return on the capital needed to produce that growth. Any other kind of growth is a trap, a narrative that convinces you to pour your money into a business that is, in effect, a financial black hole. The psychological principle that drives investors headfirst into this trap is a powerful one-two punch: the narrative fallacy and herding. The narrative fallacy, a term coined by Nassim Nicholas Taleb, describes our tendency to create and believe simple, coherent stories to explain complex, random facts. A story about a visionary CEO in a futuristic industry disrupting the world is far more compelling and easy to understand than a detailed analysis of a company's return on invested capital. Our brains crave these stories. We want to believe in the hero's journey, the tale of exponential growth. And when the media latches onto one of these stories, it gets amplified 1,000 times over. This is where herding kicks in. As the story spreads and the stock price begins to rise, Our deep-seated instinct to follow the crowd takes over. We see our friends and neighbors getting rich on this story stock, and the fear of being left behind becomes unbearable. This combination is a cognitive cocktail for financial disaster. The compelling narrative short-circuits our rational brain. We stop performing due diligence. We stop asking hard questions like, yes, but are they profitable? What is their return on equity? The story becomes the analysis. The herd's movement becomes the validation. We feel safe because we are doing what everyone else is doing. This is precisely what happened during the dot-com bubble of the late 1990s. Companies with no profits, no clear business model, and often negative ROE were bid up to astronomical valuations based purely on the story that they were changing the world with the internet. Investors were buying narratives, not businesses. When the stories fell apart and the capital ran out, those companies collapsed, wiping out trillions of dollars of investor wealth. An investor armed with the ROE compass would have seen this for what it was. They would have looked at these companies and seen that while their revenues might have been growing, their negative returns on equity meant they were incinerating cash with every passing quarter. They were getting bigger, but they were getting further and further from profitability. The ROE filter is the ultimate antidote to the narrative fallacy in herding. It's a simple, factual check that grounds you in reality. It forces you to ask, behind this exciting story, is there a real, profitable business engine? More often than not, in the case of hyped-up growth stocks, the answer is a resounding no. To make this practical, we need an applied mental model to help us classify companies and avoid the growth trap. Let's call this the growth profitability matrix. Imagine a simple four-quadrant box. On the vertical axis, you have revenue growth from low to high. On the horizontal axis, you have return on equity from low to high. Every company you analyze can be placed into one of these four boxes. The top right quadrant is high growth and high ROE. This is the holy grail. These are wonderful businesses with long runways for reinvestment. Think of a young Microsoft or a budding Coca-Cola. Finding one of these at a reasonable price is how dynastic fortunes are made. However, they are rare and often expensive. The bottom right quadrant is low growth and high ROE. These are the cash cows. Think of See's Candies, or a mature, dominant company like a major consumer brand. They may not be growing quickly, but they are incredibly profitable and generate huge amounts of free cash that can be returned to shareholders via dividends and buybacks. These are fantastic, stable investments for any portfolio growth strategy. Now we turn to the left side of the matrix, the danger zones. The bottom left quadrant is low growth and low ROE. These are the struggling, mediocre, or dying businesses. This is the Berkshire Hathaway textile mill. There is rarely any reason for a long-term investor to own these. They are value traps. But the most dangerous quadrant of all is the top left, high growth and low ROE. This is the trap. These are the companies that mesmerize the market with their explosive revenue growth, but which are fundamentally unprofitable or have terrible unit economics. They are the cash-burning startups, the growth-at-all-costs tech firms, the companies that are acquiring customers by losing money on every single one. This quadrant is where the narrative fallacy and herding are most powerful. The 99% of investors live and die in this box, chasing the rocket ship of revenue growth while ignoring the fire in the engine room. Your job as a disciplined investor is to use this mental model to consciously avoid this quadrant. When you hear an exciting growth story, your first question should be, where does this fit on my matrix? If the answer is top left, you should run, not walk, in the other direction. This simple sorting mechanism, this piece of financial education, can save you from the biggest mistakes in your investing career. The path of the 99%, the antithesis of this disciplined approach, is a constant, frantic chase within that dangerous top left quadrant. They are addicted to story stocks. They leap from one speculative bubble to the next, always hoping this time will be different. In the late 90s, it was any company with .com in its name. In the 2000s, it might have been alternative energy companies with exciting technology but no profits. In more recent years, it has been a revolving door of themes: electric vehicles, software as a service, artificial intelligence, many of which feature companies with staggering growth and equally staggering losses. The 99% investor doesn't differentiate. They hear AI, and they buy, without asking about the ROE of the specific business. They hear EV and they pile in, without analyzing the brutal capital intensity of auto manufacturing. Their portfolios become a testament to past market manias. They are filled with stocks they bought near the peak, which have since collapsed by 80 or 90%. They tell themselves, it will come back. But a business that consistently earns a low or negative return on its equity has no natural force to lift its value. They are hoping for a new narrative, a new wave of herd behavior, to bail them out of their last mistake. This is not investing. It is a form of financial gambling disguised as a sophisticated strategy. It's a journey fueled by adrenaline and FOMO, and it almost always ends in the same place. A portfolio that has grown much bigger in terms of the number of holdings, but much smaller in terms of actual value. They have mistaken the thrill of the chase for the process of wealth creation. The direct financial connection between growth and profitability is where the rubber meets the road. Let's look at two hypothetical but realistic companies to see how this plays out on their financial statements, and, ultimately, in their stock price. Company Growth Co. is the market darling. It's in a hot industry and its revenues are growing at 50% per year. It's constantly in the news. However, to achieve this growth, it spends massively on marketing and price discounts. Its business requires constant investment in new technology. As a result, its return on equity is a meager 2%. Company Qualico is in a more boring, established industry. Its revenues are only growing at 5% per year. But it has a dominant brand, a loyal customer base, and efficient operations. It consistently generates a 20% return on equity. At the start, let's say both have a book value of $10 per share. The market, infatuated with Growth Co.'s story, values it at a high price-to-book ratio, say 5x, so its stock trades at $50. The market is bored with Qualico, so it trades at a more modest 2x price-to-book, or $20 per share. The 99% pile into Growth Co. Now let's see what happens over the next decade. Growth Co.'s book value per share will compound at its pathetic 2% ROE. After 10 years, its book value will only have grown from $10 to about $12.19. Even if the market is still willing to pay a generous 3x price-to-book multiple, the stock price would be around $36.57, a significant loss for the investors who bought in at $50. The explosive revenue growth never translated into owner value. Now look at Qualico. Its book value per share compounds at its wonderful 20% ROE. After 10 years, its initial $10 book value has grown to $61.92. Because the business has proven its quality and consistency, the market might even reward it with a higher multiple, say 2.5x price to book. That would imply a stock price of over $154. The boring, slow-growing company delivered a return of over 700%, crushing the exciting growth stock. This is the financial reality. A stock price cannot permanently outrun the underlying economics of the business it represents. Value is created not by growing revenues, but by earning high rates of return on the capital invested. Ignoring this is the cardinal sin of investing, a mistake that the ROE framework is designed to prevent. This leads us to the magical heart of the entire process, the third pillar of our system, the compounding machine, and how high return on equity creates wealth automatically. This is where we move beyond simply identifying good businesses and begin to understand the powerful, passive force that drives true long-term portfolio growth. It's the engine that does the heavy lifting for you year after year, often without you needing to do a thing. Our foundational anecdote for this principle is perhaps Buffett's most famous investment, the Coca-Cola Company. In the summer of 1988, Warren Buffett made a momentous decision. Over a period of several months, Berkshire Hathaway invested over $1 billion to acquire a roughly 7% stake in Coca-Cola. At the time, this was a massive bet, consuming a huge portion of Berkshire's available capital. Many on Wall Street were skeptical. The stock market had crashed just a year earlier in 1987, and here was Buffett making one of the largest single stock purchases in history. Coke was already a huge, mature company. Where was the growth going to come from? The skeptics were asking the wrong question. They were still caught in the growth fallacy. Buffett wasn't betting on explosive growth. He was betting on the power of a near-perfect compounding machine. He had been studying Coke's financial statements and was mesmerized by what he saw. The company had one of the most powerful brands in human history. This brand allowed it to charge a premium for a product that cost very little to produce, basically sugar water. This resulted in incredibly high profit margins. Furthermore, the business required very little tangible capital. It didn't need to build the bottling plants itself. It used a franchise model where bottlers bore most of the capital-intensive work. Coke's main assets were its secret formula and its brand, assets that weren't on the balance sheet but which had immense economic value. The result of this business model was a consistently spectacular return on equity. In the years leading up to his investment, Coke was regularly posting an ROE of 30% or more. Buffett saw a business that could take its profits, retain a portion of them to grow its global brand presence, and that new, incremental investment would also earn a 30% return. The rest of the profits, the money it didn't need for growth, could be returned to shareholders through dividends and buybacks, which Coke was doing aggressively. He saw a financial snowball perched at the top of a very long, snowy hill. He understood that as long as people around the world continued to drink Coke, the business's intrinsic value would compound at an enormous rate. He wasn't trying to time the market or predict the next quarter's earnings. He was buying a piece of a business with such powerful economics that it would create wealth for him almost automatically. And he was right. His $1 billion investment in Coca-Cola has since paid Berkshire many billions in dividends alone, far more than his initial cost. And the market value of his stake has grown to over $25 billion. This wasn't because of some brilliant trading strategy. It was because he bought a phenomenal business, defined by its high ROE, and then simply sat back and let the business do the work. The compounding machine worked its magic. Coca-Cola's ability to reinvest earnings at high rates of return relentlessly increased its underlying value, and the stock price eventually followed. This is the ultimate goal of a quality investing strategy: to find a business so good, so profitable on its own capital, that your primary job as an investor is to get out of the way and let it compound. The psychological barrier that prevents most people from harnessing this incredible power is a cognitive bias known as hyperbolic discounting. This is our brain's strong tendency to prefer smaller, immediate rewards over larger, later rewards. We are wired for instant gratification. The idea of getting a 10% return tomorrow feels much more compelling than the idea of getting a 500% return in 10 years. Day trading, option speculation, and chasing meme stocks are all manifestations of hyperbolic discounting. They offer the thrill of a potential quick win, a hit of dopamine right now. Compounding, on the other hand, is the ultimate delayed gratification. Its effects are almost invisible in the short term. In the first few years, the snowball is small. The growth seems slow. The real, jaw-dropping results only appear after a decade or more of consistent progress. Because our brains so heavily discount the future, we lack the patience to let the compounding machine work. We see our high-quality stock moving sideways for a year, while a speculative stock doubles, and we feel like we're missing out. We sell our wonderful business to chase the short-term action, effectively trading a long-term fortune for a short-term thrill. We cut our flowers and water our weeds. Understanding the mathematics of compounding through the lens of ROE is a powerful mental tool to combat this bias. When you know that your business is earning 20% on its equity, you can visualize its intrinsic value growing by that amount, even if the stock price isn't reflecting it today. You learn to detach from the short-term whims of the market and focus on the long-term reality of the business. You are training your brain to appreciate the massive delayed reward that comes from owning a piece of a true compounding machine. It's a shift from a gambler's mindset to an owner's mindset. To internalize this, we can use a simple, back-of-the-envelope mental model, the compounding calculator. You don't need a complex spreadsheet for this. The goal is to make the concept of automatic wealth creation feel tangible. The model has two simple inputs: the company's return on equity (ROE) and its retention ratio. The retention ratio is simply the percentage of profits the company keeps to reinvest in the business. It's the opposite of the dividend payout ratio. For example, if a company earns $1 per share and pays out 40 cents as a dividend, its retention ratio is 60%. The formula for the company's sustainable growth rate is then simply ROE multiplied by the retention ratio. Let's use our Qualico example from before, with its 20% ROE. If Qualico decides to retain half of its profits to grow the business, a 50% retention ratio, its intrinsic value will grow at a rate of 20% times 50%, which equals 10% per year. The other half of the profit is paid out to you as a dividend, so your total return is that 10% growth plus the dividend yield. Now consider a company with a higher ROE, say 30%, that also retains 50% of its earnings. Its sustainable growth rate is 15% per year, plus its dividend. This simple calculation allows you to quickly estimate the automatic rate at which a business is growing its own value. When you analyze a company, perform this quick calculation. Is the resulting number higher than your target rate of return? Is it higher than what you could get from a simple index fund? This mental model transforms the abstract idea of compounding into a concrete number. It becomes your personal yardstick for measuring a company's ability to create wealth for you over the long term. It's the engine of your portfolio growth, and this formula tells you how fast that engine is running. The antithesis path, taken by the 99%, is the complete rejection of this patient, long-term approach. They are not owners. They are renters of stocks. Their primary activities are day trading and market timing. They believe the key to wealth is frenetic activity, buying in the morning, selling in the afternoon, trying to scalp tiny profits from meaningless price wiggles. They are glued to their screens, convinced they can outsmart the collective wisdom of millions of other market participants. In doing so, they not only pay a fortune in commissions and taxes, but they also guarantee that they will never benefit from the power of compounding. The moment a business starts to work its magic, the moment that snowball starts to pick up speed, they sell it to chase another fleeting opportunity. They are perpetually jumping off of perfectly good trains just before they leave the station. Their focus is entirely on the stock price, not the underlying business. They will sell a wonderful company whose stock has gone down 5% and buy a terrible company whose stock has gone up 5%. Their decisions are driven entirely by the random noise of the market. This constant churning is the enemy of compounding. Warren Buffett famously said, "Our favorite holding period is forever." He doesn't mean it literally, but he means that when you find a true compounding machine, your default decision should be to do nothing. Let the management team of that wonderful business go to work for you every single day, reinvesting capital at high rates of return. The 99% cannot stomach this inactivity. It feels like they are not in control. The irony is that by trying to exert constant control, they surrender the only force that can truly build their wealth for them. The direct financial connection here is the powerful, almost magical effect of retained earnings on a high ROE business. Let's trace the money. A company with $1 billion in shareholder equity and a 20% ROE earns $200 million in net income. That $200 million belongs to the shareholders. The management has two choices: pay it out as a dividend or retain it to grow the business. If they pay it out, you receive the cash, but the company's equity base remains at $1 billion. If they retain it, the company's equity base for next year becomes $1.2 billion. Now here's the magic. Because the business has a 20% ROE, that retained $200 million will now be put to work to earn a 20% return itself. The company's earning power has now increased. Next year, it will earn 20% on $1.2 billion, which is $240 million. This is the snowball effect in its purest form. Each dollar of retained earnings in a high ROE business becomes a new soldier in your army, going out to earn a high rate of return for you. In a low ROE business, the opposite is true. If a company with an 8% ROE retains its earnings, each retained dollar only goes on to earn a measly 8 cents. As a shareholder in that business, you would be better off if they just gave you the money back as a dividend so you could reinvest it elsewhere. This is why Buffett says the first question to ask about a company's earnings is, can they be reinvested at a high rate of return? If the answer is yes, then retaining earnings is a powerful act of wealth creation. If the answer is no, retaining earnings is an act of wealth destruction. A high, consistent ROE is the ultimate sign that a company has abundant opportunities to reinvest capital intelligently on your behalf, building your wealth automatically, year after year, while you sleep. This brings us to the crucial question of how a business achieves and sustains this high return on equity. It doesn't happen by accident. It is the direct result of deliberate, intelligent decisions made by management. This is our fourth pillar: capital allocation as a superpower and understanding the CEO mindset behind sustained high ROE. A company's long-term success is not determined by its products or its marketing, but by the skill with which its leadership allocates its capital. There are only a handful of things a CEO can do with the company's profits: reinvest in the existing business, acquire other businesses, pay down debt, pay a dividend, or buy back its own stock. The ability to consistently make the right choice among these options is the single most important, yet least appreciated, skill in business. It is the essence of capital management. The foundational anecdote here revolves around a man Warren Buffett has called the best capital allocator, bar none: Tom Murphy, the longtime CEO of Capital Cities/ABC. Murphy was not a flashy media mogul. He was a disciplined, rational, and shareholder-focused executive. He ran Capital Cities with an almost fanatical focus on profitability and returns on investment. His story is not one of wild, speculative bets, but of patient, intelligent, and relentless capital allocation. In the 1980s, Capital Cities was a successful but relatively small collection of television stations and newspapers. In 1985, Murphy did something stunning. He orchestrated a deal for his small company to acquire the American Broadcasting Company, ABC, a media giant that was more than 3 times its size. It was a minnow swallowing a whale. The deal was valued at $3.5 billion, a staggering sum at the time. To finance it, Murphy brought in a partner, Warren Buffett's Berkshire Hathaway. What Buffett saw in Tom Murphy was a kindred spirit. Murphy didn't care about the perks of being a media titan. He didn't care about empire building for its own sake. His entire focus was on the numbers. After the acquisition, he ruthlessly cut unnecessary costs at the bloated ABC network. He sold off assets that were not generating high returns on capital. He ran the combined company with a lean, decentralized structure that empowered managers and held them accountable for profitability. He used the immense cash flow generated by the broadcast stations to pay down the debt from the acquisition at a rapid pace. Then, once the balance sheet was strong, he began a disciplined program of buying back the company's own stock, but only when he believed it was trading below its intrinsic value. Every decision was filtered through the lens of shareholder value. Will this action increase our long-term per-share earning power? Will it generate a high return on the capital we deploy? This disciplined CEO mindset produced breathtaking results. From 1957 to 1995, under Murphy's leadership, Capital Cities generated a compound annual return for its shareholders of over 20%. A single dollar invested with Tom Murphy when he started would have turned into more than $2,000. He achieved this not by inventing a new technology, but by being an exceptionally skillful allocator of the capital the business generated. He understood that his primary job was not to run a television network, it was to manage the shareholders' money with extreme intelligence. His career is the ultimate testament to the power of capital allocation to create sustained, high returns on equity and, consequently, immense shareholder wealth. The psychological principle that separates great capital allocators like Tom Murphy from the rest is their ability to overcome what is known as action bias. Humans have a built-in preference for action over inaction, even when inaction is the more rational choice. In the corporate world, this pressure is immense. CEOs are expected to do things, to make deals, to launch new initiatives, to expand into new markets. A CEO who simply sits back and runs the existing business with quiet efficiency is often seen as boring or lacking vision. The media, Wall Street analysts, and even the board of directors often push for bold, transformative action. This leads to a flurry of activity, particularly in the realm of mergers and acquisitions. Most M&A deals, however, fail to create value for the acquiring company's shareholders. They are often driven by ego, a desire to build a bigger empire, or a misguided attempt to buy growth, frequently by overpaying for the target company. This is action for action's sake, and it is often value-destructive, crushing the acquirer's ROE. A great capital allocator like Tom Murphy or Warren Buffett has the discipline and intellectual fortitude to resist this action bias. They possess what Buffett calls an inactivity-based approach. They are perfectly happy to do nothing if there are no intelligent opportunities available. They will let cash pile up on the balance sheet rather than deploy it into a mediocre acquisition that will lower their overall return on equity. Their default setting is no, and they only swing at the rare high-probability pitches. This patience is a superpower. It allows them to wait for moments of market panic, or for a unique opportunity to arise, where they can deploy capital at very high expected rates of return. They understand that making 5 brilliant decisions in a decade is far more profitable than making 100 mediocre ones. For the individual retail investor, this lesson is critical. Overcoming your own action bias, the constant urge to tinker with your portfolio, to sell a good business because it's boring, is essential for long-term success. The CEO mindset is one of patient opportunism, not frantic activity. How can you, as an outside investor, evaluate the capital allocation skill of a management team? You need an applied mental model, a checklist we can call the CEO report card. This is how you read between the lines of a company's financial reports to judge the quality of its leadership. The primary document you need is the company's annual report, specifically the chairman or CEO's letter to shareholders. Step 1. Read the letter carefully. Is the CEO talking like a business owner or a promoter? Do they speak in clear, plain language about the business's performance, or do they use a lot of jargon and buzzwords? Do they admit their mistakes? A CEO who is transparent and talks frankly about both successes and failures is more likely to be a rational, trustworthy steward of your capital. Step 2. Look for their discussion of profitability metrics. Do they talk about return on equity or return on invested capital? A management team that highlights and rewards itself based on these key financial metrics is a management team that is aligned with you, the shareholder. If all they talk about is revenue growth or other vanity metrics, be wary. Step 3. Analyze their history of acquisitions. Go back and look at the major deals they have done. Did they overpay? Did the promised synergies ever materialize? Did the company's overall ROE go up or down in the years following the acquisition? A track record of value-destructive M&A is a giant red flag. Step 4. Examine their share buyback and dividend policies. A smart capital allocator buys back stock aggressively when it is cheap and slows down or stops when it is expensive. A mediocre one buys back stock at the top of the market just to appease Wall Street. Do they have a clear, rational policy, or is it haphazard? Using this CEO report card allows you to move beyond just analyzing the company's current numbers and to form a judgment on the skill of the people making the decisions. Finding a high ROE business is great, Finding a high ROE business run by brilliant capital allocators is how you find a multi-decade compounder. The path of the 99% is to completely ignore this critical aspect of business analysis. They might know the name of a company's CEO, but only if that CEO is a celebrity figure who is frequently in the news. They praise the so-called visionary CEOs who pursue growth at all costs, who undertake massive, headline-grabbing mergers without any regard for the price paid or the strategic fit. The perfect example of this is the disastrous AOL-Time Warner merger in 2000. It was hailed at the time as a visionary deal that would define the future of media. It was a massive, bold action. The CEOs involved were celebrated on the covers of magazines. But it was a catastrophic failure of capital allocation. The strategic rationale was flawed, and AOL massively overpaid, using its own inflated stock as currency. The deal destroyed over $200 billion in shareholder value and is now taught in business schools as a textbook example of what not to do. The 99% investor gets swept up in the hype of such deals. They don't have a CEO report card. Their analysis of management is based on the charisma of the leader, not their track record of intelligent capital deployment. They fail to understand that a CEO's most important job happens not in the factory or the design lab, but in the quiet of the boardroom where decisions about capital are made. They might own shares in a company for years without ever reading the CEO's letter, without ever thinking critically about the financial decisions being made on their behalf. They are passive passengers in a car being driven by a CEO they have never vetted, heading in a direction they don't understand. The direct financial connection between capital allocation and your wallet is immediate and powerful. Every decision a CEO makes with the company's cash flow directly impacts the value of your shares. Let's take share buybacks. If a company with an intrinsic value of $50 per share buys back its stock in the open market for $40, it is a hugely accretive act. For every share it retires, it is effectively buying $1 of value for 80 cents on behalf of the remaining shareholders. This action directly increases the intrinsic value of every remaining share and, over time, will boost the company's ROE as its equity base shrinks. Conversely, if that same company buys back its stock at $60, it is destroying value. It is paying $1.20 for $1 of value, a transfer of wealth away from the remaining shareholders. The same is true for acquisitions. An acquisition bought at a sensible price that can be improved by the new parent company will increase ROE and shareholder value. An overpriced acquisition financed with cheap debt can cripple a company's balance sheet for a decade and crush its ROE. These are not abstract concepts. These capital allocation decisions are the gears and levers that directly determine the rate at which your investment compounds. A brilliant CEO is like a powerful tailwind for your portfolio. A poor one is a constant headwind you will struggle to overcome, no matter how good the underlying business might seem. We have now assembled the core intellectual tools of our system. We have the ROE compass to find quality, we understand the growth fallacy, we appreciate the compounding machine, and we know how to judge the skill of the capital allocators at the helm. The final pillar is where we bring it all together. This is Pillar 5, building your fortress of profitability by implementing a coherent, disciplined, ROE-based investment strategy. This is about moving from theory to action, creating a robust process for stock picking and portfolio construction that can serve you for a lifetime. The foundational story for this final piece takes us back to a moment of crisis, a time when fear gripped the market and rational analysis was in short supply. It was 1963, and the financial world was rocked by what became known as the salad oil scandal. A company in New Jersey called Allied Crude Vegetable Oil had perpetrated a massive fraud. They had secured huge loans using their inventory of salad oil as collateral. The problem was, the inventory didn't exist. They had filled their giant storage tanks mostly with water, with only a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, the company collapsed, and the banks that had lent them money faced enormous losses. One of those banks was American Express. Amex wasn't a direct lender, but a subsidiary of theirs had issued warehouse receipts guaranteeing the existence of the oil. They were on the hook, and Wall Street panicked. No one knew how large the potential losses could be. Rumors swirled that the scandal would bankrupt the entire American Express company. The stock price was obliterated, falling by nearly 50% in a matter of months. It was a bloodbath. This is the kind of situation where most investors, guided by fear and the screaming headlines, would sell in a panic. But a young Warren Buffett saw not a crisis but an opportunity. He decided to do his own research. He didn't just read the news. He went out and did on-the-ground, fundamental analysis. He went to restaurants and travel agencies and observed their businesses. He talked to customers and merchants. What he discovered was that the scandal, while a serious financial hit, had not damaged the core economic franchise of American Express. People were still using their travelers' checks. Businesses were still accepting their credit cards. The underlying businesses, the parts of Amex that generated its high return on equity, were humming along just fine. He concluded that the company's fundamental earning power was intact and that it could easily absorb the losses from the salad oil fraud. The market, in its panic, was pricing American Express as if it were going out of business. Buffett, using his analytical framework, saw that he could buy a piece of a wonderful, high ROE business at a ridiculously cheap price. He famously invested 40% of his partnership's capital into American Express stock. It was a massive, concentrated bet. Within a few years, as the company weathered the scandal and its powerful earnings engine continued to churn, the stock price soared. Buffett made a fortune for his investors. This story is the perfect encapsulation of the final pillar. It shows the complete process in action, using a crisis to find a wonderful business, Amex's core franchise with its high ROE, at a fantastic price, having the analytical framework to see the reality behind the panic, and having the conviction to allocate capital decisively. This is how you build a fortress of profitability, not by avoiding volatility, but by using it to acquire high-quality, high ROE businesses when they are temporarily on sale. The psychological principles that this strategy helps to overcome are two of the most insidious biases in investing: confirmation bias and the endowment effect. Confirmation bias is our natural tendency to seek out and favor information that confirms our pre-existing beliefs. Once we buy a stock, especially a story stock we're excited about, we subconsciously start looking for good news about it and ignoring the bad news. We read the positive analyst reports and dismiss the negative ones. This can blind us to deteriorating fundamentals in a business we own. The endowment effect is our tendency to overvalue something simply because we own it. That stock in our portfolio feels more special and more valuable than it would if we were evaluating it as a new purchase. These two biases together create a powerful emotional attachment to our holdings, making it incredibly difficult to sell our losers and admit we made a mistake. An ROE-based investment strategy acts as a cold, rational antidote to these emotional traps. By building your initial process around a quantitative screen for high ROE, you are forcing yourself to begin with objective quality, not with a compelling story. It grounds your initial decision in fact. Furthermore, by continuously monitoring the ROE of the companies in your portfolio, you have an early warning system. If you see the ROE of one of your companies begin to consistently decline, it's a trigger for you to reevaluate, forcing you to confront potentially negative information rather than ignoring it due to confirmation bias. It breaks the emotional endowment effect by asking a simple question: if I didn't own this stock today, would I buy it, knowing that its ROE is falling? This disciplined, metric-driven process introduces a level of objectivity that is essential for long-term capital management and helps prevent the emotional mistakes that plague the average retail investor. Now let's codify this into our final, applied mental model, the Fortress Construction Protocol. This is your 5-step blueprint for building and managing an ROE-focused portfolio. Step 1. Screen for quality. Use a good stock screener, many are available for free online, and set your primary filter to return on equity greater than 15% for the last 5 or 10 years. You can add other filters like a reasonable level of debt, but ROE is the gatekeeper. This will immediately narrow the universe of thousands of stocks down to a few hundred potentially high-quality candidates. Step 2. Analyze for durability. For the companies that pass the screen, your job is to figure out times why their ROE is so high and if it's sustainable. This is where you do your qualitative work. What is their competitive advantage, or moat? Is it a strong brand like Coca-Cola, a network effect like a credit card company, a low-cost production advantage? You are looking for a structural reason for the high profitability, not just a lucky year. Step 3. Value the business. Remember, a wonderful business bought at a terrible price is a bad investment. This is the step where you determine a reasonable price to pay. There are many valuation methods: discounted cash flow, earnings power value, comparing to historical multiples. But the key is to have a disciplined approach to avoid overpaying. Your goal is to buy these high ROE businesses when they are trading at a fair price, or, ideally, when they are on sale due to some temporary market fear, like American Express during the salad oil scandal. Step 4. Allocate capital. Once you have an identified high-quality business at a fair price, you need to decide how much to buy. Successful quality investors tend to run more concentrated portfolios. Instead of owning 100 mediocre stocks, they might own 15 to 25 truly wonderful businesses that they know inside and out. Your best ideas should get the most capital. Step 5. Monitor and be patient. Your job is not to watch the stock price every day. Your job is to monitor the underlying business. Once a quarter, when the company reports its earnings, check in. Is the ROE still high and stable? Is the management team still allocating capital intelligently? If the answers are yes, your default action is to do nothing. Let the compounding machine work for you. This protocol is a complete investment strategy, from idea generation to long-term portfolio management. The antithesis, the path of the 99%, is to build not a fortress, but a fragile museum of mediocrity. Their portfolios are often built through a process of diversification. They buy a little bit of everything they've ever heard of: the big tech company, the big bank, the big retailer. They mistake familiarity for quality. They own a collection of popular but often average businesses with average ROEs. Because they own so many different stocks, they don't truly understand any of them. Their portfolio is a mile wide and an inch deep. They have no clear investment thesis for any of their holdings beyond it's a well-known company. As a result, their portfolio's performance tends to mirror that of a broad market index, minus the fees and taxes they incur from their haphazard buying and selling. They wonder why their portfolio never seems to achieve the kind of powerful, sustained growth they dream of. The reason is simple. Their portfolio is mathematically anchored to mediocrity. It is a collection of 8% ROE businesses, and it will, over the long run, deliver 8% style returns. They have built a portfolio that is destined to be average because they have never made quality, as defined by a high return on equity, their non-negotiable starting point. The direct financial connection of this final pillar ties everything together. Building a fortress of high ROE companies has profound, tangible benefits for your final net worth. First, it leads to lower portfolio turnover. Because you are buying wonderful businesses with the intent to hold them for the long term, you trade far less frequently. This dramatically reduces the two great enemies of investment returns: transaction costs and taxes. Every time you sell a winning stock, you have to pay capital gains tax, reducing the amount of capital you have left to compound. By holding on to your high ROE winners, you let them grow tax-deferred for years or even decades, a massive and often underappreciated advantage. Second, a portfolio of high ROE businesses is inherently more resilient. These are companies that gush cash. They have strong balance sheets and don't rely on the kindness of capital markets to survive. During a recession or a market crash, These are the companies that not only survive, but often get stronger, as their weaker, low ROE competitors fall by the wayside. Your fortress of profitability provides a level of downside protection that a portfolio of speculative cash-burning stocks simply cannot. Finally, it aligns your own financial journey with the most powerful force in economics, the compounding of capital within superior businesses. Your wealth grows not because you are a brilliant trader, but because you are a part owner of a collection of extraordinary commercial enterprises. Your success is tied to their success. By executing the Fortress Construction Protocol, you are not just buying stocks. You are systematically building a personal, diversified holding company of the world's best businesses. A machine designed for the single purpose of automatic, long-term wealth creation. You have made a significant investment of your time and attention, and in doing so you have acquired a powerful mental tool that will permanently change the way you see the financial world. You no longer see the market as a casino of flashing prices and chaotic news headlines. You see it for what it truly is, a collection of businesses. And you now possess the single most effective lens for judging the true quality and wealth-creating ability of those businesses, the principle of return on equity. You have moved from being a speculator, chasing stories and narratives, to a true business analyst, grounded in the fundamental economics of profitability. But mastering this principle is a monumental first step, not the final destination. The framework used by the world's greatest investors is a network of interconnected mental models. The principle you have just mastered, the critical question of what to buy, is one half of the complete equation. It is inextricably linked to the second, equally powerful principle that governs when to buy. Finding a high ROE compounding machine is the crucial task of identifying a target, but a great business bought at a terrible price can lead to a terrible investment outcome. The art of valuation is the other side of the coin, the discipline that connects your analysis of business quality to the price you are willing to pay. The video that YouTube is now recommending on your screen has been selected for a reason. It is designed to be the missing link in your mental arsenal. It is the next piece of the map. It takes the profound knowledge of business quality you have just acquired and forges it together with the disciplined process of business valuation. It is the bridge that connects the what to the when, transforming your powerful new skill into a complete, actionable investment strategy. This journey of financial education is a deliberate one, a conscious ascent from amateur speculation to professional-grade analysis. You have taken a massive step today. The choice before you is simple. Do you stop here, with one half of the map, holding a powerful tool but lacking its essential counterpart? Or do you click and claim the second piece? The path to completing your mental toolkit, to truly mastering your own financial destiny, continues with the video right there on your screen.